Hello, everyone. It's a pleasure to be back with my alma mater today at Kansas State and talk to you about some of the challenges that we've lived through during the COVID pandemic, and in particular, the impacts on the beef sector. So I'm going to share my slides here and we'll get going. So what I thought I would do is start with a bit of a background of what we've lived through over the past year or so as a context for setting up some of the discussions around the economics of impacts of the pandemic on the beef supply chain. Now, it's been over a year ago, hard to believe, that we started to see some early stories of consumers beginning to stock up and put more items in their pantries and their freezers, even as early as early March of last year in 2020. Then in mid-March, we had two large demand shocks. And I think it is important to emphasize where these shocks are coming from, because a year out now, and even in the middle of the crisis, I think that people often conflated all the different disruptions that they were seeing at the time. But there were two demand shocks that happened. One was a massive increase in demand for food bought through supermarkets and grocery stores. At the same time, there was an enormous reduction in demand at food service through restaurants. And so this caused a lot of disruption to run on grocery stores, some of the empty shelves that we saw. And my sense is that, at least in terms of the grocery store sector, that we got back to something that looked pretty close to normal within a few weeks. Now, of course, food service wasn't recovered, but really by the end of March, many grocery stores were restocked, and except for a few items, we're mainly back to what consumers were accustomed to seeing. But as soon as we got through those shocks, a different shock happened, this time from the supply side. Beginning in middle of April, we started to see stories of workers becoming ill in packing plants, and those packing plants slowing down and then shutting down. Here's a front page story in the USA Today on May 1st. It's not often one gets quoted on the front page of the largest circulating paper in the country, but here's me. I said that I didn't think the food system was breaking, but at least at the time, the meat sector was in very serious critical condition. And I think many of you lived through that, so I don't have to recount all of those stories at the time. Again, I think within about a month to a month and a half, at least from the consumer's perspective, maybe not all throughout the supply chain, but from the consumer's perspective, the grocery store returned to something a little more normal as shelves were stocked. Some of the restrictions on how much consumers could buy were lessened. But just about the time maybe things got to be normal and it looked like cases were falling off, there was a bit of a resurgence of cases in the summer, a reclosure of restaurants in many places. Here's an article from the LA Times where California closed again. And it just seemed like we were in a quagmire, weren't really improving. Cases started to rise throughout the fall, and we're in a bit of a stalemate. Fortunately, in December, the first viruses were given out here, or the first vaccinations were given out in the United States. And I think, since that time, there's really been a hope for a return to normalcy. We'll see. Certainly hope I don't have to add another one of these blue rectangles up here, and the next one will be, and everything was great, we returned to normal, but we'll see, fingers crossed. Now let's take a look at those shocks through the lens of prices. These are wholesale prices: beef, pork, chicken, and shell eggs. You can see, if we look at beef, for example, the dotted line, blue dotted line is 2019, the red line is 2020. And again, when consumers made that run on grocery stores, it pulled up wholesale prices of all these commodities. But then there was a dip. Now, why would there be a dip? And I think that was sort of the market understanding that we also lost a market channel. That was the food service channel. So consumers weren't going out and buying as many burgers or steaks when they were eating out in restaurants. And so demand started to dip. But then when the packing plants started to shut down, we saw this enormous run up in prices in beef and pork. Chicken, interestingly, throughout most of 2020 was below prices of 2019, just wasn't affected in the same way, although you can see some of the similar dynamics that happened there. Shell eggs is another interesting story, a dramatic run up in wholesale and retail prices that happened. I'll talk a little bit more about that in just a moment. Now, I think one thing that's important to recognize is that, whether somebody fared well or poorly during the pandemic was directly proportional to the extent to which their business depended on the food service or the grocery store market. And this is just a little snapshot of March and April, and what happened to wholesale beef prices relative to the start of March. You can see that, for some primals like round and chuck, prices actually increased in that first part of the demand shocks, whereas loin, short plate prices fell. Now, these are all coming off the same animals, so what's going on here? And I think the answer is that, what do consumers want at home? These are products that tend to be used more in ground products at perhaps a lower price point than some of these. A lot of loin products, steaks used in restaurants, short plate, things like fajitas, where people tend to eat more away from home. So it just goes to show you, even within the category of beef, you can get really big, different effects depending on where those products normally go. Now, all these prices got pulled up in the weeks that followed because of the packing plant shutdowns. If you looked at what happened in retail, just sort of aggregate meat sales, you can see the similar phenomenon. So total sales increased 90% here in that third week of March before falling back down again, but even still running quite a bit higher throughout April and May. What were consumers thinking? This is an index of consumer sentiment that's run out of the University of Michigan. They've been running this survey of consumers monthly going back to the 1950s. And a lot of wiggles in here, but the reason I wanted to show you this is this is a statistic a lot of macroeconomists use to get a sense of how consumers are feeling about spending and the overall macro economy. But this drop off that happened here from March to April of 2020 was the largest monthly change that's observed in this whole consumer sentiment index going back to the 1950s. Now, there was a big drop off in the Great Recession, but it happened over a series of months, whereas this one happened really within a single month time period. What about farmers? This is a survey that we run out of my department here at Purdue, the Center for Commercial Agriculture. Jim Mentard and Michael Lingemeyer help run this study, and we survey over 500 farmers every month about their sense of where the farm and agricultural economy is heading. A lot of wiggling in here, but again, you can see this enormous drop-off that happened from March to April of 2020 this year, and still remained fairly low as commodity prices were low throughout the spring and summer. But then a pretty big rebound has happened, and here we're still running above where we've been historically in this farmer sentiment index. So how is that possible? Well, the answers are, many commodity prices, corn and beans in particular, have really recovered this fall and winter, as we've seen a lot of increased buying from China and other places. It's also the case we had a whole lot of ad hoc government payments that flowed into the sector during this time period as well. So in fact, if you look at USDA numbers, net farm income is up in 2020. It's as high as it's been in the last 5 years, in large part due to those government payments. And so that's partly what you're seeing reflected here in these numbers. What happened to the prices consumers were paying for food? Well, you can see this is overall prices of food at home, food away from home, and a really big run up that happened here. This was in April and May, and this is, as we'll see, directly related to the increase in meat prices. We've come back down, but still running at relatively high rates of inflation. And interestingly, over the last several months, prices of food away from home have also been ticking up, which is a bit surprising since consumers aren't buying as much food through that outlet. This is what I mentioned before. If you ask sort of in the grocery store, which are the food prices increasing the most? Well, it's mainly meat products. And if we drill in a little further, it's mainly beef. So at the height of it here, prices were 25% higher for consumers than they were at the same time period last year. So again, come back down off of that, but still running 5% or so higher rates of annual inflation, which is pretty high for consumers. So we talked about prices, but what about consumer demand and sort of willingness to pay? Are consumers still wanting beef in their diets? The answer is yes. So here's a demand index that I create, a wholesale beef demand index on a monthly basis. I know Glenn Tonsor there at K-State also creates a demand index. This is a little different because this is aggregate numbers, not per capita. So this would count, say, increases in foreign demand. And this is expressed relative to January of 2019. Now, it's important to look at measures of demand like this and not necessarily per capita consumption. Consumers are going to eat everything that gets produced. So that's not really a good measure of demand. What changes is price. What we want to look at more is spending. And what this calculation does, without going into all the hairy details, is it's basically a measure of how much more consumers are willing to, more or less, consumers will be willing to buy. This is in the quantity direction at a given set of prices relative to what consumers were thinking at the beginning of January 2019. You can see today, consumers are willing to pay about willing to buy about 15% more than they were at the beginning of the year 2019. See this big spike that happened during the packing plant shutdown. So what is this telling us? It meant that, you know, buyers of beef, think of restaurants, those that were open at least, and grocery stores, were concerned about getting enough beef. They wanted to buy beef. They wanted to make sure it was available for their consumers, even at those higher prices, is what this spike tells us. Glenn Tonsor at K-State and I have been running a series of monthly surveys for a long time. This comes from the Meat Demand Monitor that Glenn's been running, where we survey consumers, 1,000 consumers every single month. One set of the consumers sees some questions like this that frames a simulated purchasing question in the context of a grocery store and asks, you know, at a given set of prices, which would you buy? And prices vary across the choices depending on which set of surveys people get assigned to. But the thing I want to point out here is what percentage of the people across all those choices choose the most popular items, which are ground beef and chicken breast. Here's ribeye. But you can see that that percent willing to buy ground beef, about 20%, hasn't really varied a lot over the past year or so. If anything, the trend is probably a little bit positive. Similar for ribeye here. By the way, here's the percent that choose this plant-based patty. You can see it's remained about 3% over the course of the last year, despite a lot of increased attention given to this. Some of that's because on average, plant-based patties are more expensive, but still it suggests that it's a relatively small part of the story at the moment. Similar question, except framed as a retail, I'm sorry, not retail, but a restaurant purchasing question, to the extent people are able to get out to restaurants and are willing to. Here you can see ribeye, for example, is much more popular in a restaurant type setting. And the two most popular items are ground beef and ribeye. And again, what you see is some wiggling around, but a fairly steady trend that the share of consumers at a given set of prices willing to choose ground beef or ribeye in a restaurant setting remains the same. Now, not as many people are going to restaurants, but of those that are conditional on going in a restaurant, stable, strong demand for beef products. Now, on that point about how many are willing and able to go to restaurants, here's the data. This is aggregate spending across the entire US economy on food at home, grocery stores, and then food away from home. And you can see before the pandemic, about 52% of all spending was on food away from home versus food at home. But once we enter those troubles, you can see this big drop off in food away from home spending and that spike in food at home. In fact, across both of these categories, total food spending was down by about 22% at in April of 2020 relative to the same time last year. Now, what about today? If we fast forward to roughly today, we're still spending more through grocery stores, about 7.5% more, and still spending less at restaurants, about 18% down. Overall, food spending is down by about 5%. This is similar data, different data source. This is a data set that tracks consumers' debit and credit card spending. This is really a fun website if you want to go play around with some of the dashboards that are there, tracktherecovery.com. But you can see this is all expressed relative to the beginning of January 2020. This big run up in spending at grocery stores, it increased 60%. And again, if we fast forward to roughly today, what you see is we're still spending more, about 12% more than we were at the beginning of 2020. And we're still down a lot food away from home. Interestingly, curiously, overall spending across all categories, not just food, is about even. There's some categories that are really down. Transportation is still down quite a lot compared to the prior to the pandemic. You also see some big differences if you look at different kinds of income categories. So what about income? Income we do tend to think about as being as incomes grow, we generally think about that having a positive impact on beef demand. This is aggregate income, macroeconomic numbers. Generally, income's been growing. Of course, it was stagnant during the Great Recession, but look what happened during the pandemic. And this is probably an unexpected result for many of you. Incomes actually spiked during the beginning of the recession, and even though they've come down, they're still above trend. Now, how is that possible? What's going on here? Well, the answer is, even though more people were laid off, we increased through government payments the unemployment benefits. And also, you've got to think about all the households that receive those $600 checks. All that factored into incomes rising in the overall economy, maybe surprisingly. If people are spending the same or have been spending roughly less and incomes have been up, where's that money going? And the answer is savings. This is a savings rate over time, a big spike here. And again, even though it's come down, we're still well above kind of historical norms in terms of savings rates. So there's a lot of money sitting out there in the economy right now. Where's it going? Well, some of it's gone to the stock market, at least in the agricultural sector. I mentioned the increase in government payments to the farm sector. There's a lot of expectations that we see through our producer sentiment survey that we run that may drive up land values here in the near future. And it does also suggest that there's a lot of money sitting on the sidelines, and if we can get these vaccines rolled out, that we may see a big spike in demand. So maybe another way of saying this is, if you have vacation plans for the summer, you might want to make them now. Otherwise, it's probably going to be busy and expensive. I talked about what impacts income tends to have on demand. So this is some kind of crude estimates I pulled together, but if incomes were to increase 10%, what would we expect to happen for different categories of purchasing? Here's beef, gets pulled up, but you know, much less than proportionally. So a 10% increase in income, maybe a 0.7% increase in aggregate beef demand in the US. The big categories that are affected positively are things like fresh fruits, food away from home. Of course, food away from home is, you know, has a constraint on it at the moment, but assuming that gets back online, we might expect incomes to pull up those categories as well. But, you know, it is, I think, challenging to think about beef as an aggregate category because income can have very different effects on different parts of the animal. So here's another study that Glenn and I did a few years ago, again, based on choices and kind of simulated retail purchasing environments like this. But if you look at demand, these are essentially demand curves I'm showing you for ground beef and for beef steak. And demand curves slope down, basically meaning as prices fall, people buy less. I'm sorry, as prices fall, people buy more. But what you see is the impacts of different income categories. For ground beef, at any given price, low income consumers are going to buy more than high income consumers. But steak, you see just the opposite. At any given price level, these high income consumers, the ones that are shown in the green dash line, are willing to buy more than the lower income consumers. So a change in income can have different impacts on different parts of the animal. And so it's important to keep that, I think, in mind as you go forward. Let's shift gears for a minute, talk a bit about the vulnerabilities that we saw during the pandemic. And I think as a rough approximation, one way to kind of characterize many food supply chains are this sort of hourglass shape. A lot of farms, a lot of different kinds of consumers, but a smaller number of processors in the middle. And if something happens to that processing sector, it can cause some system-wide disruptions. We saw this, for example, in the case of eggs that I mentioned before. You know, as consumers made a run on grocery stores, you might have thought, well, let's just take all those eggs we were sending to restaurants and just send them to the grocery store. Well, the problem is there just simply weren't, you know, things like enough cartons to send the eggs to the grocery stores, because the way we send eggs to a lot of restaurants is in liquid or powdered form to food processors too. And so there just wasn't the packing material, but also there were legal barriers too. So these are shell egg prices in grocery stores increased by about 3 times, 300% or 3 times increase relative to what happened pre-pandemic. But what a challenge was that the barns, the farms that were producing eggs that go into liquid products are they're typically pasteurized, so they have a different set of regulations. So they literally could not send their eggs to the supermarket. And as a result, these are breaker egg prices down here, liquid egg prices. They actually fell relative to what we expected they would have been if the pandemic wouldn't have occurred. Now we were able to relax some of those laws. The market kind of got back into equilibrium, but all that's a way of saying that there were all kinds of restrictions, some regulatory, some otherwise, that prevented food from flowing from areas of low demand to areas of high demand. Maybe that's an opportunity for us to think about and make sure that we get rid of some of those restrictions perhaps as they make sense, so we are better prepared for the future. Now, if we take a look at the packing sector in particular, as it relates to beef or pork, these are the locations of some of the largest packing plants in the country. So let's focus on beef here. They're the blue dotted points here. These are the 10 largest beef packing plants in the country. And these 10 plants here are responsible for about 63% of all beef processing. So they're big enough, if something happens to one of these plants and it goes down, it can have system-wide disruptions. Now, we have this level of concentration in the beef packing sector because, at least in good times, it means that that it's relatively affordable to process meat. It means lower meat prices for consumers. It also tends to mean that cattle prices are higher than they would be otherwise, relative to a less efficient packing sector. But a potential downside is, again, that if something happens to one of these large plants, it can cause system-wide disruptions. So what did happen? These are weekday daily processing numbers in 2020 relative to 2019. And you can see this is cattle and hogs at the worst of it, late April, early May. We were down about 40% relative to the same time the prior year. Again, chicken not nearly as affected. A bit unclear why. Some of it could be most of chicken processing is in different areas of the country than these, and the virus hit those areas of the country at different times. It could also just be that the size of these chicken plants is different, and maybe the labor density might not be as high. Most of the labor in these plants is involved in what you might call disassembly. Chicken's just a smaller animal. You don't need as much labor to break down each chicken. But the truth is, I don't know exactly why chicken processing wasn't as adversely affected as cattle and hogs were. So I think one suggestion that's come out of a lot of this is that, to be more resilient, what we need is just a lot more plants out there. So I've just randomly placed some more dots over this graph. And would a system like this be more resilient? I don't think there are easy answers to this. Would we be better off with more small and medium processors, more local processors? Perhaps. I think the issue wasn't really one of size. I think it really was an issue of capacity. The issue was when these plants went down, there was no extra space for these animals to go. And if you think about what was needed in that environment was more capacity, which is another way of saying to increase resiliency. In a lot of systems, what you need is redundancy in the system. The problem with redundancy and excess capacity is it's expensive. Can you imagine going to your banker and saying, I want to take out a few $1 million, build a big piece of capital facility, and leave it sitting idle? That's just not a very attractive proposition, I think, for most businesses, and the same is true during the pandemic. Now, that doesn't mean there might not be opportunities for more small and medium processors, or even for some of the big packers, perhaps add more capacity as a form of insurance, even if it does add some costs. I think that's maybe one lens through which people will be looking at this stuff. Been working on some research with one of my colleagues here at Purdue, Malin Ma, asking this question of, what would different market structures look like? What happens if we lived in a world that was comprised of many, many smaller packers versus this blue dot is the world we live in now? And if you lived in that world, what if there was some risk that was out there? It's maybe a risk of fire or a risk of a coronavirus, where at any point in time there's a 30% risk of one of these plants closing down. How much production might fall? And this graph is telling us that, what's the chance of output falling by 20%. You want to be on the bottom side of this curve, and it says that our current structure actually outperforms a structure of a lot of small plants at making sure that output doesn't fall by 20%. But the smaller structure is one at preventing worst case outcomes, like output falling by 40%, for example. But again, the differences here, the odds of that happening versus here, they're not as stark as one might imagine in terms of differences in the industry structures. I think one of the reasons this has been controversial is because when a large packing plant closes, it has big impacts on market prices and in ways that I think have been concerning for a lot of industry participants. And here's a report that came out this summer from the USDA that was both touched on the packing plant fire out in Holcomb, Kansas that closed a Tyson plant, and then also the pandemic itself on price spreads. And I think this has been a big source of controversy throughout the industry. So what's happened? I'm showing the change, and the blue line is wholesale box beef prices. The red dashed line are live cattle prices relative to the beginning of 2020. And you can see it at this time period here where we had this big run up in wholesale prices. This was also a period right before it where cattle prices fell. And indeed, we're still at a point where that price spread is higher than it's been otherwise. Here's just looking at that price spread, the difference between the wholesale price and that live cattle price. Here's that packing plant fire. We saw that increase in the price spread, and then a really big increase that we saw here during COVID-19. And we're still kind of, again, running above where we've been for the last few years. And maybe just to put it in historical perspective, going back, for a decade or a couple decades or so, you can see these events we've had in recent years are pretty remarkable relative to what we've witnessed. So I think it's these movements that have caused a lot of consternation. I think one of the things I've tried to emphasize during this is, while they're certainly concerning and no doubt unpleasant, they're not necessarily unexpected in terms of what economic theory would suggest. This graph is just showing you those increasing price spreads have caused a lot of headlines, and we've seen a lot of legislation that's been proposed in response to that. But this is a messy graph. I don't expect you to digest all of this, but what I want to just tell you is, if I'm teaching my Econ 101 class and I get to ask a question, what happens if for some reason there was a disruption to the packing sector? What would I predict would happen? And I would have said, even before all this fire, the prediction is that if a packing plant closes, demand for cattle is going to fall. A packing plant doesn't have the ability to run as many animals through there, and so there's an excess supply of cattle relative to the ability to process them. So the price of livestock has to fall because demand has fallen. At the same time, there's less meat being produced. There's less meat on the market, and so you have the same number of consumers and grocery stores competing against each other for that meat. So they're going to bid up the price for that meat because there's less of it on the market. So the supply curve for meat shifts inward, meat prices rise, and you get an increase. I should say here, instead of margin, it's the price spread that increases as a result. And this is true, regardless of whether there's any market power or not. This happens even in a world where they're all very small packing plants. One of the other things we've noticed through some of our simulations we've been running is that what you can't see in that price spread is the costs. And in worlds where there's a chance of packing plant closure, what happens is, as that chance of packing plants closing increases, the marginal cost of processing beef increases quite dramatically. So, in our simulation models, it's not hard to get outcomes where you get packing profits falling even as the price spread increases, which seems counterintuitive. But that can occur if the costs are increasing at the same time. And so maybe, we can't directly observe costs of packers, but what we can do are look at the stock prices, at least of those firms that are publicly traded. And one way to think about stock prices is they reflect the market's perception of the profitability of those industries. And these market participants are people literally putting their money where their mouth is by trading these stocks. So if we look at what's happened to a number of stocks relative to the beginning of 2020, you see a lot of the industries really took a dip in the early stages of the pandemic. But look at at least the two packing firms that are publicly traded took a hit and have really stayed quite low. So even coming out to today, about 25 to 30% below where they were at the beginning of 2020. Overall markets, the S&P 500, which is the index of many of the largest companies in the country, took that hit, but really performed quite well, up about 20% since the beginning of 2020. Now, some food, some companies in the food industry have done pretty well. Here's Walmart up about 16%. Why? Well, it's completely related to that fact that more consumers are going into grocery stores to do their shopping. But it does tell you that throughout this pandemic, it's just because price spreads have increased doesn't mean necessarily that people are better off. And in fact, I think it's been a lot of pain to go around. But none of that is to say, of course, that cattle producers haven't felt pain either. And maybe to give you a little bit of an illustration of that is this is a sort of a crude estimate, but what I've done here is take revenue, the total number of steers and heifers in the economy times the price in 2020 relative to 2019, or not relative to 2019, relative to the average of the past 3 years. And what you can see here is that early in 2020, we were either above or about on par with where we'd seen in the past, but really those revenues dropped quite dramatically through spring and summer, and have even remained lower than where they've been for the last 3 years. So if I add up all those changes since about beginning of April of last year, I get about a $4 billion reduction in revenue, or about a 10% reduction in total revenue on an annual basis. So, it's certainly been the case. I think COVID has hit the beef industry particularly hard, both on the producer side, and also if you look at those stock prices, probably also on the packer side. And if you look at the retail prices for consumers too, they're paying more for beef as well throughout all this. So what's ahead? A lot of discussion these days about plant-based meats, what's happening there. That's probably a discussion for a different day. But I do want to point out that these are retail scanner data. Percent growth remains quite strong. This is back in April, 100% growth. They experienced the same run up in prices, even at a higher level than did meat products during the time. Some of this is because they're starting from a pretty small base, but still, I think does suggest a lot of growth going on in that industry. If you want to see more about kind of what research is suggesting that consumers are thinking about some of these plant-based alternatives, what impacts they may have on beef demand, here's a report that I helped prepare with Glenn and Ted Schroeder there at K-State. So a lot of interesting stuff in this result, this report, and hopefully the next few months you'll see more results come out from that. So just to conclude, sort of what's ahead, I think it's what's happening with retail prices. We've seen the inflation start to come down, but still at a fairly high level. We've seen a lot more purchasing of food through online channels. I think we'll continue to see that even for meat. We just recently did a survey last month of consumers, and about 25% said they bought meat online within the last month. So I think that will continue to be a trend as we go forward. I think it's probably the case that grocery stores may in the future start to look a little different. There's in some cases, as more food is being bought online, some of these retailers may find it profitable to create these little micro fulfillment centers, what they're calling dark grocery stores. Essentially, all they're doing are filling all the online orders that are now taking place inside the grocery store. I think we'll probably see a push towards automation, particularly in the packing sector. Labor has been an issue for a long time, and I think it's just been a different dimension of labor challenges for that industry. And so I think investments in automation in that sector, and maybe even in the food retailing sector, is one that we're likely to see. Probably because of these changes in price spreads that we've seen, there's going to be, there already is a lot of increased scrutiny over concentration, anti-competitive behavior. All that I think is happening at the same time as we're also seeing a lot of really interesting movements in terms of vertical integration in the sector. We're seeing retailers getting into the packing space. We're seeing some packers trying to get into direct to consumer markets. So I think it's a really interesting and dynamic time. And I think for cattle producers, it's interesting, will be important strategically to see how you can be a part of some of those changes that are happening. Who knows exactly how the food service sector is going to come out of this, what's going to happen to restaurants. I think some fast food chains have probably been just fine. At least sales through drive-throughs have remained fairly strong, but in the more sit-down kind of traditional restaurant sector, will be interesting to see how it plays out. People have spent more time cooking at home, and may be something that they stick with more than they have in the past. Even before the pandemic, there was a rise in what you call these ghost kitchens. These are restaurants that don't have the front of house. Basically, they're a website that are filling orders through, DoorDash, Grubhub, those sorts of things from a kitchen. And I think we'll probably continue to see more of that again as people become accustomed to ordering food and eating online. I think, partly because of some of the shutdowns that we saw in meat packing, there's been, I think, a rising interest in sourcing meat from local segments, maybe direct delivery from small, more medium-sized packers. I think that is an opportunity that will grow, and there'll be some niche marketing opportunities there. It'll probably remain a small piece of the overall story, but I think still an opportunity that does exist for certain entrepreneurs. So with that, I will stop. It's been a pleasure to be with you here today and to chat a little bit. I look forward to your questions.